Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 290 of our YouTube channel and podcast, and I cannot be more excited to continue sharing with you guys personal finance topics that I think could be useful for you in your long-term financial journey. Today, we are going to continue our talks on the 401k, and specifically, we're going to talk about 401k vesting. Now, if you don't know what that is, do not be alarmed. I'm going to break it all down for you, and we're going to talk about exactly what vesting is, what vesting schedules typically look like, and why this may be relevant to your own retirement savings situation. And little do you know, it could be a part of your retirement situation because it is a part of many individuals' 401k situations. So stick around for everything that I have for you about 401k vesting and vesting schedules. And hopefully this can help you to navigate your 401k a little better as you move forward. So stick around for all that and more in today's episode. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcast, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions, and you and I can begin working together, pushing towards your long-term financial goals, and then ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual watching or listening to this show on a day-to-day basis. Now, you guys know my feelings on 401ks. It's very, very clear how I feel about them, right? And when I'm talking about 401ks, I don't want you to get this misconstrued. I'm talking about any employer-sponsored retirement account that is like the 401k. So the 401k, the 403b, the TSP, anything that is like that can offer you a match, that has potential Roth or traditional options, that's treated in much the same way as IRAs other than a few different rule changes, has much higher contribution limits, all those different things, all the advantages that we've already talked about this week, right? I'm talking about all of those things. I'm not just talking about the 401k, but when I say the 401k, know that I'm wrapping those in. But a lot of individuals have 401ks far more than those who have TSPs or 403bs. So that's what I'm going to stick with. That's the verbiage I'm going to use, okay? Now, I've talked about the 401k a lot. I talk about in the financial action plan actually taking the 401k match or the employer-sponsored retirement account match in the third part of the financial action plan. And I tell you to do that before I ever tell you to get out of debt, before I ever tell you to build up a fully funded emergency fund, before I tell you to invest heavily for your future, before I tell you to pay off your house, right? And the reason I typically tell you to do that is because in the situation where you're getting a match, you're getting a 100% return on some amount of your money, whether it's 3% of your money or 6% of your money or 11 or 12% of your money, right? Whatever your workplace is offering, you're getting a 1-for-1 match up to a certain amount, right? You're getting a certain amount of money for absolutely free. And it's the highest rate of return that you can make on your money anywhere, 100%. Now, how does this play into what I'm talking about today? Well, something that plays into the company match is what's called vesting and vesting schedules. And vesting is just this fancy word for basically saying we're not going to give you all the money all at once. Okay, and you may say, well, why would they not give you all the money all at once? What does that mean? Well, if you look at your retirement account, the money is in there, right? So whatever match you get, the money is in there, right? But it's likely broken down into what you are vested into and what you are not vested into. And all this means is what you are vested into is what you could take with you if you stopped working at that job today. But what you are not vested into is what you cannot take with you when you leave a job today. Okay? And so what employers do is they will put these vesting schedules on your 401k, which basically says, hey, we're going to start this company match as soon as you start with your 401k. But this money is not your money until you work here a certain number of years, right? So it's basically a way to keep employees around, right? It's a benefit to employees if they become longer tenured employees. Now, you can see where this is beneficial to the employer, right? And you can also see where this is beneficial to the employee because ultimately the employee is getting the match. But should this make you think twice about taking the match? Should this make you think twice about where I tell you to do this in the financial action plan? Because this may be a situation, right, where you are like, well, I could do other stuff with this money, and that money's not even mine yet, and all these different types of things, and I don't want to be putting money in and wasting money. I'm going to talk about all of that in today's episode. And what brought this to mind for me, because I've told you many times, I go through and I'm looking at articles day by day by day. There's an article, here's how long workers wait for a company's 401k match to become their money. Okay, so it's basically all it's talking about is vesting schedules. And so I thought it was very pertinent, given that we've been talking about 401ks a lot lately and haven't brought up the idea of vesting too much. Okay, so let's go through this article a bit, talk about what it talks about, and give you a little bit of my commentary. So it appears that most workers have to wait years for a company's 401k matching contributions to become entirely theirs. The majority, 82% of employers that offer traditional 401k plans say that they match a portion of their workers' account contributions. Now, I've told you many, many times, that is the ultimate benefit of the 401k. The ultimate benefit of any employer-sponsored retirement plan is the fact that you can get some type of match, is the fact that they are going to match the amount of money that you put in. Otherwise, right, the major advantages from there are just high contribution limits and the ability to get your money earlier, or if you're putting money in, to a Roth 401k, there's no income limits there, right? But you lose the flexibility of investing by investing into a 401k, right? And if your 401k doesn't have a match, then there's not a whole lot difference between doing that and putting money into an IRA, Roth IRA, whatever else, other than those couple things I just named. Now, however, the research shows that just 28% of these employers let employees immediately take full ownership of that extra amount. Okay, so what does this look like? What does this mean? This means that whenever the matching contributions are actually made, right, only 28% of the employers that offer these 401ks allow their employees to just have that as their money, meaning that those employees could quit after their first contribution and take that money with them, and that is still their money. Now, otherwise, other than these 28% we're talking about here, vesting times, how long you must work at a company for its matching contributions to be 100% yours, range from up to 1 year, which is 13% of 401ks, to 6 years, which is 10% of 401ks. So let's just look real quick at the breakdown of the amount of time that it would take to vest 401ks in the United States. Okay, so this is from a survey of respondents of 452 U.S. employers. Okay, again, immediate, meaning as soon as the contributions are made, that's 100% the employees, 28% do that. Okay, so you can see the majority have some vesting schedule, have some type of vesting. How long is it going to take? Let's look at it. 1 year of vesting, 13%. 2 years of vesting, 7%. 3 years, 14%. 4 years, 6%. 5 years, 17%. And 6 years, 10%. And then there's a 5% number that is unknown. They don't know how long their vesting schedules are. I don't know how you wouldn't know in this particular survey, but they do not know. Now, this is interesting. And looking at this little bar chart that they have here, I think it's interesting to note that for many of these employers, the majority of these vesting schedules are done on odd year increments. I don't know why. I don't know what the reasoning may be, right? But you had 13% at 1 year, 14% at 3 years, and 5 years you had 17%, right? So there, what do you have? You have 44% of these vesting schedules occurring in odd year increments. And then, like I said, 28% happen immediately. So less obviously are happening in the even year. So again, that's just an observation. I don't know exactly why that would be so, but it is the case. Okay. Now, all that these vesting schedules are doing, all that they're doing is they are making it to where you don't get all of the employer's money unless you are putting in an adequate amount of time via whatever they think an adequate amount of time is for that employer. And for most vesting schedules, right, it's not like you have to work 6 years to get any of the matching contributions, or 3 years for any of the matching contributions. You get a percentage of the matching contributions every single year that you work there, right? So you vest into these matching contributions. That's how it works typically, okay? I'm sure different ones have different rules. This isn't a hard and fast thing, but I'm just telling you how I've seen it done in the past. Now, Employers who don't immediately 100% vest the match do so because they want to reward longer service employees. Okay, now vesting either happens gradually, so this would be like what I was talking about. You would have 20% of the match in year 1, 40% after 2 years, and then all the way up to 5 years, right? So like 20% a year, or if it's 3 years, you might get 33.33% per year up unto 100% vesting, right? So it either happens like that, or it occurs all at once after the vesting period. Okay, now that would be the one that obviously sounds the least beneficial to the employee, right? Because you're like, okay, I have to work here a certain number of years to be able to touch any of that money, to be able to put any of that money in my pocket, right? Which can be a big deal, right? And if I'm the one sitting here telling you, hey, let's put money into an employer-sponsored retirement account in order to take advantage of the match, and let's say you've got, a 6-year vesting schedule, right? You have this 6-year vesting schedule, and it only vests 100% at the end of that 6 years. There's no gradual vesting, right? You have to really think about, am I going to be working here for 6 years? And if I'm not, then I'm going to be putting money into a 401k that likely has higher fees than an IRA, right? Is not likely to benefit me above and beyond being, there for the match if you actually stay there for 6 years, right? But the truth of the matter is that the median number of years that the worker in America today, the employee in America today is staying at a job is 4.1 years. Okay, so a 5 or 6 year vesting schedule, especially if it is all at once, at the end of that vesting schedule may be a long time, and it may not be very likely that you actually get there. Now, this is going to have to be determined on a case-by-case basis, but it brings up why I want to talk about this today, because it shows a place in the financial action plan where things are not so clear, where things are not so 100% true 100% of the time. Now, if you are getting some gradual vesting, I still want you to take your match. 100%. I want you to take your match. Now, here's why. Because at the least, okay, let's say that there's a 6-year vesting schedule. Okay, that means that each year you're getting 16.67% of the vesting. So that means every year that you work somewhere, every year that you work at this particular employer, right, you're going to get 16.67% on the amount of money that you put in. Okay, which is a great automatic return, and that just is on top of whatever other return. And if you work there the median number of years at a 6-year vesting schedule, right, you're going to have 2/3 of the amount of money matched that you should have, right? So you get a 2/3 return, a 66.67% return, right? That's an outrageous return to get immediately once you put your money in. Now, of course, I'm all about the 100% rate of return, okay? But ultimately, that 100% rate of return is still on the table, right? If you end up working there through the entire vesting schedule. And I'm assuming the worst. I'm assuming here that the vesting schedule is 6 years long. I'm assuming that you're having to deal with a very, very long vesting schedule. And in doing so, right, you get very little each year. But if you've just got a couple year vesting schedule and you're likely to stay at this employer for a couple years, right, this should not at all impact your willingness to invest. So if you're getting gradual build up to full vesting, then of course, take the match, do what I say in the financial action plan 100%. But if you have a 5 or 6 year, and this is what I'm going to put the caveat at here. If you have a 5 or 6 year vesting schedule, and it is an all-at-once vesting schedule, okay, meaning that you don't get any of the money until you've worked there 5 or 6 years, and then you get it all at once, okay? If that is the case, and you don't see yourself working somewhere 5 or 6 years, and the statistics, again, show 4.1 years is the median number of years that an employee is going to stay somewhere, right, then it may not be worth it for you to be putting money into this 401k for this amount of time. Again, because a 401k is likely to have higher fees than other investing places, and I'm not telling you to invest anywhere else at this particular point in the financial action plan. All that I'm asking you to do is just take the match because of the rate of return that you just absolutely can't beat. But if you're not going to get that rate of return, if there's not a likelihood of you getting that rate of return, then you putting that money away is going to be quite useless. Now, let's not forget though, if you do make it to that 6-year vesting schedule, that 5-year vesting schedule, all that money does become yours. Okay. So let's not lose sight of that and lose sight of that benefit. And that may actually be something that pushes you to work somewhere longer. Okay, but you have to be realistic. You have to be realistic with your ability to get there. Now, let me be clear. You not investing in your 401k is not going to keep you from getting to where you want to be over the long term. Okay, just because you may have a longer all-at-once vesting schedule doesn't mean that you won't be able to get to where you want to get to because you're not going to work anywhere long enough. That's not what that means. Okay, what it means is you may use that money that other individuals would put towards that match and get out of debt faster and build up an emergency fund faster. And then once we do that, start investing up to the match in that 401k. So you're not going to just, bow out for that whole 5 or 6 years, right? Let's make sure we have our financial foundation set, and you can get it set faster than other people because you'll have more money in order to do so, right? Because you're not putting money into your 401k in order to get the match. So you would use that money, pay off your debt, build up an emergency fund, and then, yes, even if it's got a vesting schedule, go for it, right? Start investing. And here's the cool part. The cool part is let's say that it takes you, 3 years to get out of debt and to build an emergency fund, whatever, right? Let's say it took you 3 years, which I think is the maximum it should take individuals who are really, really serious about it and really budgeting and tracking their expenses in a real way. So if it takes you 3 years, and let's say you have a 6-year all-at-once vesting period, and let's say you have a 6-year all-at-once vesting schedule, right? That means your vesting period, you're already 3 years in. Okay, so you can start investing in your 401k, and if you do so for 3 years at that employer, right, then you'll get 100% of the money that was matched and that you were putting in. And what this will allow you to do is it will allow you to get out of debt faster than your friends. It will allow you to, have your money in your emergency fund faster than your friends, and it will allow you later on to have more money going towards that 401k when you first begin than your friends. But again, if you have any type of gradual vesting, by all means, take advantage of it because those free returns are going to be hard to find no matter their size, okay? Now, let's continue on in this article. It says, the additional money saved by not vesting short-term employees can be used to provide a large match to longer service employees, okay? So this is what these employers are thinking. These employers are thinking, hey, if we withhold money from the short-term employees until they become long-term employees, it can save us a lot of money because on the books, right? On the books, the money's showing up. On the books, this match is happening. But if those employers don't stay there, right? If they leave, then the company gets the money, right? It's still the company's money until those employees either vest up or they leave, right? So this is a way for employers to cover their tails and to keep short-term employees from taking advantage of the benefits that they might offer and making sure that they can do larger matches to longer service employees. Now, this may be something that you actually see. These companies that have these longer vesting periods or these all-at-once vesting periods may actually end up having very big matches, right? It may be the very reason that they did this type of vesting period in the first place because they don't want individuals coming in and just taking advantage of the huge match that they offer. Okay, so if you have a huge match like that and you can take advantage of it in the short term and you think that you'll stay around if that type of benefit remains around, then by all means do it, right? And it's not going to hurt anything, right? It's really not going to hurt anything if you're just investing and then you don't end up getting all of the money. It's not going to absolutely hurt anything because you're still going to have all the money there that you invested, right? Let's not get this twisted. This is still going to allow you to have everything that you have invested to this point, right? You just might not get everything that the company had invested for you up to this point. So don't think that you're going to lose any of your money when it comes to vesting because that's absolutely not true, right? Your vesting schedule has everything to do with the employer's money that they're putting into your account, not your money that you're putting into your account because that's always your money and will always be. Now, again, the median number of years that workers stay with an employer is 4.1 years. And 28% of employers require a waiting period of more than 4 years. So this brings up what I was talking about earlier, right? So despite the potential for a long crediting schedule, it's still worth contributing at least enough to get your company match if you can afford to do so. Like I said, right? It's still worth it, right? It's still worth investing up to the match. Absolutely. And again, I'm saying in the terms of you're not out of debt yet, you haven't built up an emergency fund yet, you're not aggressively investing yet. We're just talking about at the beginning of the financial action plan. If you get to the point where you should be investing at least 15% of your income, absolutely take advantage of the match, even if you have a longer vesting schedule, because one way or another, you would be investing that money anyway, right? And if we can, hopefully get a hold of some or all of a match. That's absolutely what we want to do because that is free money. Even if you don't think you're going to stay at a particular company long enough to get the match, it's still worth contributing at least enough to earn it. Okay. Now, financial planners continually beat the Save for Retirement drum, and the amount you need to put in a 401k to get the match is well below the amount that you should save each year. And this is absolutely true again in the sixth part. And this is absolutely true again in the sixth part of the financial action plan. I'm saying you shouldn't be investing anything other than up to the match early on, right? Again, the discrepancy here with the financial action plan has nothing to do with part 6, because part 6, yes, go get the match, right? Part 3 is saying, yes, go get the match, but you may rethink it if you have one of those longer all-at-once vesting schedules and you need to get out of debt and all those types of things as well, okay? Now, additionally, you never know what the future may hold career-wise, okay? In other words, you may end up staying at a company longer than you originally anticipated, right? So you may look and you may go, I don't think I'm going to stay here long, so I'm not going to be a part of this all-at-once vesting period for 5 years or whatever. And then you look up 15 years later and you go, I wish I would have gotten that free money, right? It's better to have, tried and to have put money away, and still that is your money. Okay, 100% that is your money. But it's better to have put that money away and then been wrong, right, than to look up later on and have not put that money away and not tried to get that match and be down a lot more than you would have otherwise, okay? So all else fails, I'm okay with you just, putting money in the same way that I'm telling you to in the financial action plan. But this may be a particular type of consideration that you have to bring into mind. Now, if you're able to contribute more than just enough to get the match, right, you probably should. And again, I say in the sixth part of the financial action plan, 15% or more of your income, right? We still want you to be able to spend money and to be able to enjoy what you have in the sixth part of the financial action plan, but you should be out of debt. You should have an emergency fund built up, right? This should be what you're doing. Now, this doesn't mean that all your money should be going into the 401k. We've talked about our hierarchy of investment before, how the 401k plays into that, because it does absolutely play into that, especially if you're offered a match. So that's at the top of the list, right? But the lack of flexibility can be something that leads us into things like IRAs and other investing vehicles. Now, the most common matching formula, according to Fidelity Investments, is 100% match for the first 3% of your salary that you contribute, with a 50% match for the next 2. Okay, so this means ultimately that they're going to give you 4%. Okay, if you put in 5%, they're going to put in 4%. Okay, so this would still be worth it, right? This would still be way worth it when it comes to a match. And by all means, take advantage of all the free money you can get. So by way of example, say your annual salary is $50,000. If you were to contribute just enough to get the employer match, the most common matching formula would mean you contribute 5% and your company would put in 4%. So it would be $2,500 on $50,000 over the course of a year, and the company would put in $2,000. So that would be $4,500 over the course of the year that would be put in by you and the company together. Now, if you did that for only 1 year, the money would be worth about $26,200 in 30 years based on a 6% annualized return according to Fidelity. If you were to do that 5 years in a row with your salary increasing 2% yearly, your account would be worth roughly $69,000 in 30 years. 10 years in a row, $202,300 in 3 decades. And the amount that came from the employer match would be $89,900, or 44% of the amount of money that you ended up putting in there. Now, those are not overwhelming numbers, and they don't use high rates of return, right? And they're also not looking at a situation where you're putting away 15% plus of your income. But to say that 44% of the amount of money that you would put away there would end up coming from the employer match is absolutely huge. And it just shows you the power of this employer-sponsored retirement account and the matches that you could get. I want you to get these matches because it is free money and it can compound into a lot over a long period of time. It's not just the return that you get immediately. That's what I tout and that's what I talk about, right? I say you get the 100% return immediately and you just can't beat that, and that's 100% true, right? But you also can't beat the fact that you got free money to get free compounding on for the next 30 years, 40 years, however long you will remain invested in a particular retirement account, right? It's absolutely huge that you do take advantage of employer-sponsored retirement accounts with matches, vesting schedule or not. It's huge that you do. Remember, too, that if you have a traditional 401k plan, your contributions are made pre-tax, which reduces your taxable income and, in turn, how much you pay in taxes, although your withdrawals in retirement will be taxed. If it's a Roth, your contributions are made after tax, but distributions later in life are generally tax-free. And whether you contribute to a traditional or a Roth, the company's match always goes into the former and is not taxable compensation, okay? So in every case, the employer match is going to be pre-tax money. So if you ever rolled money from a 401k into IRAs, right, you would have to roll the match portion into a traditional IRA and the Roth portion, if you do have a Roth portion, into a Roth IRA, right? You have to keep those monies separate. Okay. Also, employer contributions do not count towards the maximum contribution that you can make. So right now, $19,500 is the maximum contribution you can make to a 401k over the course of a year, right? The match doesn't count towards that, right? So let's say that, you're putting away, I don't know, $200 a month, right? $200 a month into your 401k. Let's say it's getting matched 100%, right? That's $4,800 a year. That's not coming anywhere near that limit of contributions. But it wouldn't be the whole $4,800 that would go towards it. It would just be $2,400, right? It would just be the $200 a month that you put in that was going towards that particular contribution limit. There is no limit for the matches. There's only limits for the amount of money that you put in. But again, nonetheless, right? We're here to talk about vesting schedules. I want you to know that I am not worried about vesting schedules. I don't have a problem with vesting schedules. Yes, it may stink for you, especially if you leave an employer early. It may absolutely stink, but maybe you'll get something out of the deal. Like I said, I've seen a lot of these situations where they're not all at once, okay, where they are gradual vesting, right? They gradually vest you in. Or if they are all at once, it's very quick all at once, right? Typically, they don't make you wait 5 or 6 years for an all at once. Typically, they don't make you wait 5 or 6 years for an all at once. And if they did, it's likely that they have a huge match waiting for you on the other side in order to vest into. So just weigh your pros and cons in the third part of the financial action plan. But I think for the vast majority of individuals, the vast majority, you should be doing the financial action plan exactly like I'm saying. Only in the smallest of small situations, right? The fewest of few situations should you be deviating at all. And that is only, again, if you have a 5 or 6 year plus vesting schedule that is all at once, right? And you're not out of debt and you don't have a fully funded emergency fund, because once you have that, then you would do it regardless, okay? So just keep all this in mind, understand what's going on, and hopefully next time you get any type of disclosures from your 401k, and maybe it talks about a vesting schedule, or maybe you go online and you pull up, Vanguard or Fidelity or whoever you have your 401k through, and you're looking and you go, this says vested amount or vesting schedule. What does that mean, right? That vested amount is the amount of money that you can actually take away, right? But it's going to differ if you're still within your vesting period. It's going to differ from the total amount in the account, right? And it may differ greatly from the total amount in the account, but you have to understand what's going on there. And then you may want to dig a little deeper. Okay, then what's my vesting schedule? How long is it going to be till I can get my hands on all of this money? This is stuff that you do need to know. You do need to know this. So if you do leave a job, right, regardless of being fully vested or not, you'll know the amount of money that you can take away. Okay, you'll know the amount of money that you are entitled to. And again, this is some of the minutia of personal finance, of retirement investing, of 401ks, of retirement planning. But if you better understand this, if you have a better grasp on what's going on here, then you may also have a better grasp on how much money you'll actually have to take with you, how much money you'll have to retire, how much money you'll have to grow for you over a long period of time, right? This can be extremely relevant if you're talking about somebody who may have moved jobs later in life, right, and been putting money into a 401k and then wants to retire because they think they've got a certain amount in an account, but then it turns out they're not vested into that full amount. They're only vested into some of it, and they don't get as much as they thought. This is something that can be very relevant, and you should definitely keep your eyes on it. But the good news in all of this is, once you get fully vested wherever you're at, it's all gravy. You don't have to worry about it, right? You're going to get that full match no matter what. And you should keep getting that full match and keep getting that full match and keep getting that full match until the cows come home. Because again, you cannot beat free money, and you absolutely cannot beat free money that's going to continue to grow for you for years and years and years. So keep getting it, keep going after it. Use the 401k for what it's worth because it can be worth something, but notice the disadvantages that may come with longer vesting schedules and with vesting schedules that force you to wait until it's all at once and don't give you any type of gradual vesting. So hopefully this helps, right? Hopefully this helps you to have a better understanding and knowledge of 401ks and exactly what's going on in your own retirement accounts. So thanks for watching this video. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of these platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions, and you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing on towards long-term financial freedom, which is what I hope for every single individual who is watching or listening to this show on a day-to-day basis. So tune in Monday as I continue talking about personal finance topics that I think could be useful for you in your long-term financial journey. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.